When debt grows faster than the ability to pay it, mathematics guarantees default. On January 18, 2024, the Institute of International Finance released its quarterly debt analysis, revealing that global debt had reached $315 trillion across all sectors, government, corporate, and household debt combined. This represented a $25 trillion increase in just 18 months, bringing total global indebtedness to 331% of world GDP. But buried within the technical analysis was a mathematical reality that no policymaker wanted to acknowledge. Interest payments on existing debt now exceed $87 trillion annually, consuming more resources than the entire global economy produced just 2 decades ago. The $87 trillion annual interest payments represents mathematical impossibility because it exceeds the sustainable debt service capacity of the global economy by margins that cannot be resolved through conventional economic growth. When interest obligations grow faster than productive capacity, mathematical laws of compound interest create exponential debt acceleration that guarantees systematic default regardless of policy interventions or economic performance improvements. Understanding global debt mathematics requires recognizing that compound interest operates according to exponential growth patterns that eventually overwhelm any finite economic system. Debt that grows at interest rates exceeding economic growth rates creates mathematical progression toward insolvency that cannot be reversed through conventional policy mechanisms without fundamental restructuring of debt obligations. The mathematical foundation of debt sustainability depends on interest payments remaining below economic production capacity, while debt levels remain manageable relative to income generation. When interest payments exceed production growth, debt mathematics creates systematic conditions where borrowing becomes necessary to service existing debt, accelerating total debt accumulation toward mathematical impossibility. Current global debt mathematics demonstrate systematic breakdown of sustainable borrowing relationships because total debt service requirements have grown beyond the productive capacity of the global economy to generate sufficient income for payment obligations. The mathematical progression has reached thresholds where debt reduction becomes impossible through conventional economic growth mechanisms. Historical analysis reveals that debt-to-GDP ratios exceeding 300% consistently result in systematic default, hyperinflation, or debt restructuring because mathematical relationships between debt obligations and productive capacity become unsustainable. Every major economy that has reached current global debt levels has experienced monetary system breakdown within predictable time frames. The Roman Empire experienced debt crisis during the 3rd century when government obligations exceeded productive capacity, forcing currency debasement that created hyperinflation and systematic economic collapse. Roman debt mathematics followed identical patterns to current global conditions, demonstrating mathematical inevitability of breakdown when debt service exceeds sustainable thresholds. Weimar Germany provided modern precedent for debt mathematics breakdown when reparation obligations exceeded German productive capacity, forcing money printing that created hyperinflation and economic destruction. German debt crisis demonstrated mathematical impossibility of servicing obligations that exceed economic production capacity regardless of political intentions or policy creativity. Contemporary examples include Argentina, Venezuela, Greece, and Lebanon, all experiencing debt crises when obligations exceeded sustainable service capacity relative to economic production. These examples demonstrate mathematical universality of debt breakdown patterns that operate independently of specific economic policies or governmental systems. Current global debt acceleration follows mathematical progression that suggests systematic breakdown approaching within predictable timeframes based on compound interest calculations and debt service growth rates relative to economic production capacity. Mathematical analysis indicates debt sustainability thresholds will be exceeded regardless of policy interventions that cannot alter fundamental mathematical relationships. Government debt represents the largest component of global debt accumulation, with sovereign obligations exceeding $70 trillion globally, while continuing to accelerate at rates substantially exceeding economic growth. Government debt mathematics creates systematic problems because sovereign borrowing crowds out private investment, while creating taxation pressures that reduce economic growth capacity. United States government debt alone exceeds $34 trillion, with annual interest payments approaching $1.5 trillion, more than total defense spending and representing faster growth than any major spending category. U.S. debt mathematics demonstrate mathematical impossibility because interest payments grow exponentially while economic production grows linearly, creating divergence that cannot be sustained indefinitely. European Union combined government debt exceeds $15 trillion, with several member nations maintaining debt-to-GDP ratios above 100%, while facing demographic challenges that reduce tax-based capacity relative to spending obligations. European debt mathematics indicates systematic breakdown probability, increasing as aging populations create spending pressures exceeding revenue generation capacity. Japanese government debt exceeds 260% of GDP, representing the highest developed nation debt ratio, while facing population decline that reduces economic production capacity relative to debt obligations. Japanese debt mathematics provide preview of demographic-driven debt crisis that awaits other developed nations facing similar demographic transitions. Chinese government debt officially exceeds $15 trillion, but unofficial estimates including local government and state enterprise obligations suggest total Chinese debt approaching $50 trillion. Chinese debt mathematics indicate systematic problems because debt acceleration has exceeded economic growth, despite official statistics suggesting continued expansion. Corporate debt represents another massive component, with global business obligations exceeding $85 trillion, while corporate earnings growth has slowed substantially relative to debt accumulation. Corporate debt mathematics creates systematic problems because business borrowing has been used for financial engineering rather than productive capacity expansion. United States corporate debt alone exceeds $18 trillion, with substantial portions representing leveraged buyouts, share repurchases, and financial restructuring that created debt obligations without corresponding productive capacity increases. American corporate debt mathematics indicates systematic fragility because debt service requires earnings growth that current business models cannot sustain. European corporate debt patterns demonstrate similar mathematical problems, with business borrowing concentrated in financial engineering activities rather than productive investment. European corporate debt mathematics suggests systematic breakdown probability as earnings capacity fails to keep pace with debt service requirements. Chinese corporate debt officially exceeds $20 trillion, but unofficial estimates, including shadow banking obligations, suggest total business debt approaching $35 trillion. Chinese corporate debt mathematics indicate systematic problems because debt acceleration has substantially exceeded earnings growth despite official economic expansion claims. Household debt represents the final major component, with global consumer obligations exceeding $55 trillion, while household income growth has stagnated relative to debt accumulation. Household debt mathematics creates systematic consumption problems because consumer spending capacity becomes limited by debt service obligations rather than income growth. United States household debt exceeds $17 trillion, including mortgages, student loans, credit cards, and auto financing, while median household income has grown minimally in inflation-adjusted terms. American household debt mathematics indicate systematic consumption constraints because debt service absorbs increasing percentages of disposable income. European household debt patterns show similar mathematical deterioration, with consumer obligations growing faster than income capacity across most major economies. European household debt mathematics suggest systematic consumption breakdown as debt service requirements exceed sustainable percentages of household income. The mathematical interaction between government, corporate, and household debt creates systematic feedback loops that accelerate total debt accumulation beyond sustainable thresholds. When all sectors simultaneously increase borrowing, mathematical debt dynamics create economy-wide leverage that cannot be sustained through conventional economic growth mechanisms. Demographic factors amplify debt mathematics problems because aging populations in developed economies create systematic pressures that reduce tax-based capacity while increasing spending obligations. Mathematical analysis of demographic trends indicates debt service capacity will decline substantially as worker-to-retiree ratios deteriorate across major economies. Social Security and pension obligations represent unfunded liabilities exceeding $100 trillion globally that do not appear in official debt statistics but create mathematical obligations that must be serviced through taxation or money printing. Unfunded liability mathematics indicate systematic problems that exceed official debt calculations by substantial margins. Healthcare cost obligations represent another category of unfunded liabilities that grow exponentially due to aging demographics and medical technology costs. Healthcare liability mathematics indicate systematic spending pressures that cannot be sustained through conventional revenue mechanisms without fundamental restructuring of medical service delivery. Interest rate mathematics create additional systematic problems because central bank policies that keep rates artificially low enable debt accumulation beyond sustainable levels while creating asset bubbles that collapse when rates return to normal levels. Low interest rate policies defer debt mathematics problems without resolving underlying sustainability issues. Central bank balance sheet expansion represents monetary policy response to debt mathematics that creates systematic inflation pressures while enabling continued debt accumulation. Quantitative easing policies defer debt crisis through money printing that reduces currency purchasing power while maintaining debt sustainability illusion. Federal Reserve balance sheet expansion from $800 billion to over $8 trillion represents monetary accommodation of debt mathematics that creates systematic currency debasement pressures. Fed policies enable debt sustainability temporarily while creating long-term mathematical problems that cannot be resolved through continued monetary expansion. European central bank policies demonstrate similar mathematical accommodation through negative interest rates and massive bond purchasing programs that enable debt sustainability temporarily while creating systematic currency and banking problems. ECB policies defer debt crisis through monetary manipulation that creates additional mathematical impossibilities. Bank of Japan policies provide extreme example of monetary accommodation with decades of quantitative easing that enables debt sustainability while creating systematic economic stagnation. Japanese monetary policy demonstrates mathematical impossibility of resolving debt problems through unlimited money printing without fundamental economic restructuring. The mathematical progression toward debt crisis acceleration suggests systematic breakdown within predictable timeframes because compound interest mathematics operate independently of policy interventions that cannot alter fundamental mathematical relationships. Debt service capacity has mathematical limits that current global debt levels have already exceeded. Default represents one mathematical resolution mechanism when debt obligations exceed payment capacity by margins that cannot be bridged through conventional economic mechanisms. Historical debt defaults demonstrate mathematical inevitability when debt service requirements overwhelm productive capacity regardless of political commitments to maintain payment obligations. Hyperinflation represents alternative mathematical resolution mechanism when governments choose money printing over explicit default. Hyperinflationary episodes demonstrate mathematical relationships between monetary expansion and currency collapse that operate independently of policy intentions to maintain currency stability. Debt restructuring represents third mathematical resolution mechanism that involves reducing debt obligations to levels that can be sustained by available productive capacity. Debt restructuring episodes demonstrate mathematical necessity of aligning debt service requirements with realistic payment capacity based on economic production capability. Current global debt mathematics suggest resolution mechanism activation within predictable timeframes because debt service requirements continue growing exponentially while productive capacity grows linearly. Mathematical divergence indicates systematic breakdown approaching regardless of policy preferences for avoiding crisis recognition. The timing of debt crisis manifestation depends on maintaining confidence in debt service capability, despite mathematical evidence suggesting sustainability impossibility. Confidence breakdown typically occurs when mathematical reality becomes too obvious to ignore through policy narratives or economic performance manipulation. Interest rate increases accelerate debt crisis timing because higher rates immediately increase debt service requirements while revealing mathematical impossibility of sustaining debt levels that appeared manageable during artificially suppressed rate periods. Rate normalization exposes debt mathematics that low-rate policies temporarily concealed. Economic growth slowdowns accelerate debt crisis timing because reduced production capacity makes debt service more difficult while revealing mathematical impossibility of growing out of debt obligations through conventional economic expansion. Growth disappointments expose debt mathematics that expansion assumptions temporarily masked. The mathematical certainty of debt crisis resolution through default, inflation, or restructuring operates independently of policy intentions or political preferences, because mathematical relationships impose constraints that cannot be overcome through institutional decisions. Debt mathematics create systematic forces that eventually overwhelm policy resistance regardless of governmental capabilities or determination. Understanding global debt as mathematical bomb rather than policy problem provides insight into why conventional solutions consistently fail to restore debt sustainability. Mathematical problems require mathematical solutions that align debt obligations with productive capacity through explicit recognition of sustainability constraints that policy narratives typically avoid acknowledging. The $87 trillion annual interest obligation represents mathematical impossibility that cannot be diffused through conventional policy mechanisms because debt service requirements now exceed global productive capacity by margins that continue expanding through compound interest acceleration. Mathematical analysis indicates systematic breakdown approaching with certainty rather than mere probability. When debt grows faster than the ability to pay it, mathematics guarantees default. Global debt has reached mathematical thresholds where resolution through default, hyperinflation, or restructuring becomes inevitable, regardless of policy interventions that cannot alter fundamental mathematical relationships between debt obligations and productive capacity limitations.